minutes. I'd like to welcome all stakeholders on the WebEx and on the phone. Welcome to the meeting of the Accounting and Auditing Working Group. Let me start this meeting with a short introduction, what we are doing. We have external relationships with the IASB, IAISB, the monitoring group, and the PIOB. Then next thing is we observe developments in the field of accounting, auditing, and financial reporting or valuation, and also public disclosures. We are preparing therefore comment letters and other papers to external bodies in relation to the above for approval by the Policy Development Committee, our parent committee. So we support the capital solvency by developing, updating, or providing input into the development of updating of IAIS high-level principles-based supervisory and supporting material relevant to accounting of insurance companies, auditing of insurance companies, valuation for solvency purposes, audit assurance required for information provided to insurance supervisors, reporting to supervisors, and public disclosures of insurers. So let me switch to ongoing project, ICP 14. So we are in late stage of our internal work, I would call it. We are waiting for approval for the public consultation, which is expected in June 2023. And then the public consultation will start from July until October 2023. Next thing is ICP disclosures project. There are potential revisions as a result of recently concluded targeted jurisdiction assessments. And the Accounting and Auditing Working Group will work with the CRSG, the climate group, climate steering group, in determining how to amend ICP 20 to address work of the International Sustainability Standard Boards, ISSB. Also, we are providing comments on accounting and auditing published milestones. So we did a fatal review of IFRS 17 insurance accounting standards. We are monitoring the work of the ISSB, including upcoming climate-related disclosures and general sustainability-related disclosures. Expected comment letters to the ISSB standards. The ISSB seeks feedback on its priorities for the next 2 years. And we also work on the IAASB for its consultation proposal on sustainability assurance. So those are the milestones for the summer. Next thing is we have a coordination with BCBS and FSB. So let me point out here the work in the monitoring group with the reform project. And also with the FSB, the upcoming FSB roundtable, which will be at the beginning of June in Madrid, and where we will be a participant amongst the BCBS. Also later this year, we were invited by our South African colleague to participate in an IFRS 17 roundtable in Cape Town. This will be in September, and the objective is to share regulatory and supervisory experience of IFRS 17 implementation, including discussions on challenges faced by supervisors and regulators as they monitor insurers in their respective jurisdiction, as well discuss solutions to these challenges. So participants will include supervisors, auditors, life and non-life insurers from Africa and emerging markets. So basically, that's a short subcommittee update, what we are working on and what are priorities over the long term and also in the short term. And here I would stop and provide stakeholders the opportunity to step in and ask questions or address issues they would like to raise. Doug?
Doug, can you unmute yourself? The floor is yours.
Okay. Seems like he's having technical issues. Okay, he's back.
Okay. All right, so I'm a panelist now, so I can say something. Guten Tag, Marcus. Good to see you again.
Good to hear you, Doug.
So I want to thank the chair and the members of the AAWG for giving industry the opportunity and participants to have this discussion with you. From your remarks, it's very clear you have a very, very busy agenda and quite a lot to do over the next, just even over the next few months over the summer. So we'll try to address a few things that we have discussed at the Global Communications Group. And so I wanted to open it up by asking Marietta Price from VVO to start the discussions. I see Marietta there.
Thank you, Doug. Good afternoon, everybody. Yes, as Doug said, I'm working for the Austrian Insurance Association. I had already the pleasure to be with the AAWG last September. And last year, I gave to this group a short summary what is going on concerning sustainability regulatory requirements at the EU level. So I will intend to give you a short update and to address some comments and concerns of the insurance industry. If I will miss something important, Felipe Angelis from Insurance Europe is also with us, and he will add if it is necessary or if I miss something. So, as you know, the Corporate Sustainability Reporting Directive, which follows or is the revised non-financial reporting directive, was published last year in December. And for the many of the insurance companies, first reporting concerning the scope in the first slot, companies which are already forced to do mandatory reporting under the NFRD will be the first one to do this under the CSRD. So this concerns the financial year 2025 and reporting in 2024 and reporting in 2025. Nevertheless, now we have new criteria for mandatory reporting. So we will have a phasing in. That means that also small and medium-sized insurance companies will 1 year later then be in the scope. But the first, as I said already, are those who have already to do sustainability reporting. And I reported last year already that therefore there was also a new governance structure for EFRAG required, because the so-called level 2, the sustainability reporting standards were developed by EFRAG, and EFRAG submitted a first set of standards to the European Commission in end of November last year. And there was a call for evidence to the ESAs from the Commission to give already a first comments on these drafts end of January. And the first set comprises 12 standards. We have 2 cross-cutting standards general requirements and disclosures, 5 for the environment, climate change, pollution, water and marine resources, biodiversity and ecosystems, and resource and circular economy. We have 4 for social issues, comprising own workforce, workers in the value chain, affected communities, and consumers and end users. And last but not least, we have 1 for governance, the so-called business conduct. As you know, there were already in the summer last year a first draft, and we recognize it in positive amendments to this preliminary draft in summer in comparison to this, these standards now reported to the Commission end of November. And the most positive changes are that there was really a reduction of mandatory disclosures, and that the related data points also are now only more than 1,000 in comparison than the former drafts more than 2,000. Another amendment, which is very important for the insurance industry, was the abandonment of the concept of rebuttable presumption. This was replaced by a company-specific materiality assessment. So companies are allowed to omit disclosure requirements and data points that are deemed not material to the company. But as you know, the European concept is based on double materiality in comparison to the basics of the ISSB drafts, as we know. Another positive result is that under the NFRD, there was a group exemption clause, so that subsidiaries are not forced to do their own sustainability reporting. It can be made on consolidated level. This exemption clause is also now incorporated under the CSRD, with 1 exemption that public interest entities, which are listed companies or their bonds are listed on a regulatory market, they have to do their own sustainability reporting. We are now waiting because the European Commission announced that there will be a public consultation for these drafts. We really are waiting because first it was announced for March, then for April, and now for May. Today is already the 11th, but we hope that we will get it soon, because in the CSRD is laid down that the European Commission has to adopt these IAIS by end of June. So we heard rumors that this adoption will not be in time. Okay, this will be followed up by, I think, an amendment of the CSRD, because it is a red line a date, but we will see. And we heard also that the response of the ESAs and also the communication so far with the EC and the EIOPA and EFRAG may also lead already, or possible amendments will be reflected in this consultation. Nevertheless, the CSRD has to be transposed in national law within 18 months. It was published in the official journal of the EU. So yeah, we're a little bit more or less in a hurry, because for the companies, the reporting requirements, even there were some reduction and some easing of the concept, is a great challenge to implement all these requirements, and the better we know what is the end of the outcome, it is good for the industry. But on the other hand, we are seeking, we are hoping that some of our concerns will be reflected in the final IAIS. One of the main concerns we have is that the value chain definition is not defined for financial institutions, and the work plan of EFRAG foresees that the next working plan is that there will be created sector-specific sustainability reporting standards for those sectors of the industry which are carbon intensive. So banks and insurance companies were foreseen to have drafts be published only in mid-2025, but this can even be later because the Commission reflected the need of the industry and the whole industry, not only the insurance or the banking industry, that we need guidance for the first set of these standards. So EFRAG has now the duty to develop a guidance, because also the basis for conclusions have not enough information that implementation can be fulfilled in the sense of the regulation. Another topic we have concerning small and medium-sized entities, as you know, also the Solvency II review is ongoing. And in comparison to banks, we have not incorporated in reflection of proportionality that there are some easing for small and medium-sized insurance companies, because the criteria for the reporting is now laid down in the EU reporting directive, in the general reporting directive, and therefore maybe there will be an amendment also when Solvency II review will reflect also in this regulatory directive some easing for small and medium-sized insurance companies. Another topic we have is alignment with the IFRS sustainability disclosure standards developed by the ISSB. The chair already announced what is going on the ISSB side. They did also a consultation. They will also have a consultation for their final, or for the draft for the first set, for the first two standards. And the chair already mentioned also the working plan of the ISSB, which was launched last week. I assume that also other ESG goals will be also handled by the ISSB, or the consultation is asking where should be the priorities, also concerning human rights and some other environmental goals like biodiversity, for example. So I will stop here. Maybe Felipe Angelis will add something. If you want, I have also some comments concerning other EU regulation in connection with sustainability, like the Corporate Sustainability Due Diligence Directive. But I think the most important for us now is the implementation of the CSRD and the IAIS. Thank you for the moment.
So, Caitlin?
Hi, yes. I wasn't sure if Adam was going to speak before me. So just quickly introducing myself, I'm Caitlin Wagner from the Association of British Insurers. Just going to provide a quick update from a UK perspective on what we are looking at in terms of financial reporting and then corporate reporting briefly. So we submitted related to the IFRS Interpretations Committee on its tentative agenda decision on insurance contract premiums receivable from intermediaries. We welcomed the IFRIC's tentative agenda decision to not add a standard setting project to the work plan. And we supported the IFRIC staff's conclusion that accounting for insurance contract premiums and receivable from intermediaries under IFRS 17 or IFRS 9 was acceptable. We see this conclusion as enabling impacted insurers to present fairly their financial performance and position, supporting them in providing decision useful information to the users of financial statements. We also urge the board to ensure deliberations are concluded swiftly and in a timely manner to give the 2023 preparers the certainty they need to prepare the financial statements. We continue to monitor the progress of IFRS 17 implementation and embedding within the UK insurers specifically, especially with interim reports expected for many in the coming months. In terms of corporate reporting, we await the release of the S1 and S2 exposure drafts, which are expected in June. The ABI inputted into the JIFIA response to the consultation on these standards. We, as the ABI, will look to hold discussions with the relevant UK regulatory bodies on whether these standards will be endorsed for use in the UK. We intend to respond to the consultation released on the 4th of May on the ISSB's agenda priorities for the next 2 years, as well as our intention to respond to the ISSB's consultation published today on its proposed methodology for enhancing the international applicability of the SASB standards. Related to the UK green taxonomy, so in its green finance strategy, the UK government indicated it will support industry as it develops new market frameworks, associated tools and expertise required to expand green finance activity. It plans to deliver a UK green taxonomy, a tool to provide investors with definitions of which economic activity should be labelled as green. This will support the quality of standards, labels and disclosures used in the industry for green finance activity. The UK government expects to consult on the taxonomy in autumn 2023, so later this year. The government will engage with market participants to drive forward and understand how best to design a taxonomy which achieves its objectives, ensuring that the information generated through a taxonomy is decision useful to both investors and companies and can be produced in a simpler, proportionate way. The government will continue to work with the Green Technical Advisory Group, otherwise known as GTAG, building on their expert advice. GTAG released a paper earlier this year in February on promoting the international interoperability of UK green taxonomy, which set out 10 recommendations to support UK leadership on green finance. In other areas, the Financial Conduct Authority released its consultation on sustainable disclosure requirements earlier this year. Towards the end of last year, apologies. It was on sustainability disclosure requirements and investment labels, which aims to protect consumers from greenwashing and help them navigate the market and more informed decisions. This also included anti-greenwashing rule, which will apply to all regulated firms, with proposals to affect asset managers, their UK-based fund products and portfolio management services. Our understanding is that the FCA intends to consider expanding this further at a later stage. The ABI submitted our response in January, which was broadly supportive of their proposals. Various comments were made on proposals that pose practical challenges. Were made on proposals that pose practical challenges and may have unintended negative consequences or points that need more clarification. The FCA is expected to publish its policy statement later on in June, and we remain in close contact with the team at the FCA responsible for the paper. Lastly, in 2021, the Chancellor announced the establishment of the Transition Plan Task Force as part of the UK's plans to become the world's first net zero financial centre, ensuring financial flows shift towards supporting net zero. The TPT consulted on the TPT disclosure framework and implementation guidance from November of last year to February this year. The ABI submitted a response to this consultation in which we highlighted the continued need for the TPT to align its worth with other initiatives, both formal regulatory proposals and international alliances that have developed the transition plan structures, the need for the content of transition plans to be reviewed regularly and inform climate policy making at national and international levels. Transition plans must be usable as the evidence base for other elements of the climate reporting regime. It is expected that the final disclosure framework and implementation guidance will be published in autumn of this year, and the ABI will continue to monitor developments in this space. That's all from my side.
Okay, thank you, Caitlin. Adam?
Okay, can you hear me now?
Yes, we can hear you.
Oh, great.
Welcome, Adam.
Can you see me as well?
Not yet.
Okay. Oh, okay. It's
Yeah,
obvious.
now we can see you.
Great. Thank you, Chair. It is really a pleasure to be on the screen for you. And it's a miracle that it is possible. I just see that my control buttons are dynamic somehow, so I was not in a position to unmute. I was not in a position to let you see my face, but great that you made it possible. Otherwise, you would have only been in a position to enjoy my voice and to recognize the guy from GTV being in favor of goodwill amortization. So let's start with this remark. For those colleagues for those members of the committee who don't know me, let's say some words about my person. I have been working for the German Insurance Association since more than 11 years already. I am responsible mainly for IFRS accounting issues, and therefore my job is really to closely follow what is happening at the ESB level, what is happening at the EFRAX level, and at what is happening during the relevant discussion at the German level as well. Today, I would like to reflect on some IFRS issues, so I will not go beyond that, it's promise. So I tried also not to be repetitive and be brief, so we have a chance to ask questions, if any. Let me start with a general remark, because I think you might be interesting to also hear that one. And that's why before I turn to the first topic, I would really like to express the view that ESB is doing a good job, I think, currently. And it is not the case that we agree with all the decisions, but my impression is that they are very pragmatic. There are concerns here and there. Some important issues would have been appreciated by us if the ESB would have decided differently, but overall, they are focused somehow. They are keen to implement projects. They are standing ready to provide pragmatic remedy where necessary. I think it has to be acknowledged and said explicitly. Let me start with where my colleague Kathleen from IBI was with IFRS 17 interpretations activities. There's absolutely no disagreement here with UK and German market. And just to give you additional insight, it is clear somehow that we would like to have a period of stability for our members. It is clear many topics have been discussed and decided in the implementation projects. Some of them were very intensive. They caused a lot of headaches, but they have been solved in close cooperation with the responsible auditor. They had to be overcome because the projects had to be established. They had to be accomplished. Debit and credits had to be determined. And we believe that principle-based standard cannot be approached differently. It requires the preparers to exercise their professional judgment, and the same applies to auditors. So I think this is this general observation I would like to say ahead of further comments. Hence, any request to the IFRS Interpretations Committee are causing discussions and are seen as a problem. But we do understand that it is not in the hands of the committee, of the Interpretations Committee, whether submissions are made or not. And then when a request is there, they have to approach it. It's their job to follow the due process, so that you understand we see the other side as well. And recently, indeed, the committee got these 2 submissions on the same topic, on this premiums receivable from an intermediary. It was a sensitive topic for the implementation work. And the question was if 17 or IFRS 9 should apply. And the tentative agenda decision after extensive audit says that both views are valid. And we very much agree with the decision that you have to start with 17, but there is also a good line of argumentation that you can apply IFRS 9. So it is very much appreciated that the outcome is technically valid one, and at the same time it does not destroy the processes implemented ahead of 1st January 23, simply just recently. And we will also contribute to the consultation where the deadline is the 22nd of May. We will support and welcome the decision that no standard setting is required for the reasons provided by the staff and for the reasons provided in the tentative agenda decision. So I was thinking, I was not sure if the committee is looking at the tentative agenda decisions of the interpretations committee, but I think you should be aware where the industry stands in this. Actually, tomorrow, one of our major members will provide the first quarter's results for the first time based on 17 and 9. The next will follow further. So it's a really exciting time to see how it is going really in to the new normal, IFRS 17 being a new normal basis for insurance accounting with this increased transparency, with this increased comparability, which is actually great. We are very positive about having these 2 standards in place. Let me now refer to the second issue, which I think you might be interested in our views as well, IAS 12 amendment, IAS 12 income taxes. You might be aware that the OECD level member states agreed to establish a minimum tax rate regime on large companies. The objective will be achieved via top-up taxes, which will be to be paid by the group level in reference to the situations in different jurisdictions, which is a new situation where the parent entity has to pay on top for something which is happening at subsidiary levels because the effective tax rate is below 15%. The complexity of this Pillar 2 system is huge. It is a challenge even for tax experts, for excellent tax experts. Some elements are still moving parts. A lot of aspects of this project are not really clear, and the local legislation is ongoing, and consequently the challenges to approach the different taxes in this context are highly complex. And here once again the CSB is stepping in, and it recognized the need for urgent clarification how to set up accounting for different taxes in this context. The pragmatic remedy the ESB provides is a temporary exception, as you might know, is a mandatory exception, however, and we agree with this approach. It is a mandatory because it is really good to ensure comparability and consistency in accounts where necessary, where possible, and temporary because we know all ESB doesn't like exceptions, but there is no sunset clause envisaged anyway for the envisaged amendment. So what does it all mean? Yeah, reporting entities will not need to deal with the deferred tax issues in the context of Pillar 2 activities at the local level. And The ESB also fine-tuned the disclosure requirements for this case to allow users to have some insight, but not to over-challenge the industry or the preparers. So they confirmed that the current text related to Pillar 2 will be disclosed separately, but they are very cautious what to require ahead of this current text being really due. So we have contributed as a German association to the ESB consultation. We appreciated that the ESB set up an additional board meeting in April to finalize the amendments quickly, still in May. In the EU, you know, we will still have to make the endorsement steps subsequently to benefit from the pragmatic amendments, and the issue will arise what to do at the half-year reporting. But specifically, I also here would like to express that I like the 3 issues on this project. The ESB set up the project once they have been made aware of the issue. They developed a pragmatic solution. They consulted on the proposals very quickly. The ESB reviewed and reacted properly to the comments regarding cost benefits assessment of the proposed disclosures, and they are going to release these important amendments still in May. So it's a good, I think, situation. Let me talk as the third issue about shortly about the exposure draft with proposed amendments to IFRS 9 financial instruments, which is currently also an ongoing consultation. Here, I would like mostly to make a comment that from my personal perspective, the consultation with our members still has to come. From my personal perspective, the ESB is doing here very elegantly, a very smart move towards addressing the issue without changing the principles of the standards. And how are they going to accomplish it? How are they going to approach it? They do not create any new exception, do not provide any solution, as the EFRAG was requesting urgently, but the ESB's approach is to clarify that existing principles and requirements in the standard can and should be understood in that way that the cases the stakeholders have in mind may be treated as preferred. Hence, the clarification goes in the direction that this PPI test can be positively taken, even for debt instruments with these ESG features, if some conditions like features being specific to debtors, borrower, and some other nuances in the ED are fulfilled. The proposal is not, as you know, not focused on SCG features only, but on all contractual terms that might change the timing or amount of the cash flows. I have to say that generally, and as of today, I like the approach very much, as it does not seem to cause damages, or it does not cause the need to redo the IFRS 9 project of insurers. My impression is that also EFRA goes in the direction of agreeing with the direction of the ESB work, but nevertheless, now they are starting to require the ESB to be even more quickly on this as they already are. So finally, a comment regarding the additional issue incorporated in the ED on top, the proposed disclosure requirements for equities. Here, I don't believe that they replace the need for recycling, to be honest. It is not what the industry was asking for. What we have been asking for is if the equity instrument is sold, the realized gain and losses should be presented in the profit and loss statement. And it is still, for me personally, a kind of a strange situation that equity instruments accounting for at fair value through OCI doesn't have to be tested for impairment at all. So finally, let me focus quickly on last 2 projects. I would like to spend some remarks. PFS project and goodwill accounting. PFS project, you know, this primary financial statements, a project on the new standard for performance reporting. We hope very much that tomorrow the ESB papers for the May ESB meeting will provide a good basis and thorough analysis for a good discussion at the upcoming meeting the week after. Here our concern is whether insurance will be in a position to present their operating profit in a consistent manner. Also regarding the results from the joint ventures and associates issues accounted for at equity. We believe that the principles for the specified business model where investing is a main business activity, that no exception treatment should apply. And just to say it also clearly, we don't think that here the industry is asking for a special treatment. What we are asking for is a ability to properly present the performance like other industries can. And finally, regarding the ESB decision on goodwill, I don't want to hide my disappointment but I also understand that the ASB is going to consult still on the envisaged disclosure requirements package, and they are going to consult on some changes to the impairment model they think might make the deal. It will provide an opportunity for stakeholders and for us to reinforce our point of view. As you know, we believe that goodwill should be amortized, or at least companies should have an option to amortize it. We don't follow how the impairment model can be relaxed even more if it is not working as assessed by the ASB itself in the past. So the project, also the further project from the agenda consultation on intangibles will be also another opportunity to share our views on goodwill accounting as well, on goodwill acquired in a business combination. Hence, overall, we are not intimidated by the current status quo. Jointly, we could make the difference, I believe. So with this, I would like to close my comments by saying thank you for your attention. Happy to answer any questions you might have. And I still would have then one question to you as chair. Or I can continue with this question if you like.
So do we have any questions to Adam? No, you can continue.
Okay, so the question is another topic of concern. You possibly know ESP is working on the IFRS of a new IFRS accounting standards with reduced disclosure requirements for entities without public accountability. And the question here of our concern is that insurance industry is punished double. The first thing is that they are thrown out of the scope. The second one is that for IFRS 17, there is no proposed reduction disclosure requirements. And I'm not talking about global champions, global companies operating on a global basis on capital markets. I'm talking about those insurance entities which might already today or in some future be able to apply IFRS in the situation where they are not listed, where they are not capital market oriented. And the rationale the ASB is providing for the scope exclusion is you are public accountable because even if you are not capital market oriented, you are acting in the so-called fiduciary capacity. And I was wondering if the committee has discussed this proposed scope exclusion, because we, at least in the German market, and I think in the European context as well, we don't think that that insurers are acting in a fiduciary capacity, because when insurers is receiving a premiums payments, it's their own money, and they invest it on their own risk. And there is afterwards a participation of policyholder and the original obligation to pay the claims when they arise. But I don't think it is not a different situation where I give money to a fund where my money is managed by a fund manager. Insurance are providing insurers coverage and receive premiums for that. So I think that there is still this pre-assumption that insurance are not in the scope of this new standard because of this reference to this fiduciary capacity. But this is the explicit intention, but we don't think that insurance are. From the legal perspective and from the economic perspective, they are not acting in fiduciary capacity. So this unclarity is causing us a lot of headache. So it would be actually for this be good to look at this issue again. I know that they decided not to change the proposed scope currently, but to look and follow the situation. There is also the link to the IFRS for small and medium-sized entities standard, but I think at least this link could be decoupled. But the question, coming to the conclusion, the question be, does the committee has looked at the project where some reduction in disclosure overload is intended, but there is also the intention to exclude the insurance industry from this relief. Thank you.
So you want me to answer? No, in such detail we haven't looked at it, but we plan to look at it. So the simple question, it's short. No, we we are very thankful for your comment, and we will have a look at this for sure.
Yeah, just to observe, we are in a very late stage, but I think it seems to me to be a kind of a fundamental misunderstanding where your knowledge as a committee might be helpful with the process as well.
Just let me ask you one question for this one. I was thinking about the classical business, the classical German life insurance and the fiduciary duty. And then I was thinking about life insurance with coupled with a fund investment.
Unit-linked contracts, yeah.
Yeah. So
so we have indeed these nuances hasn't been explored in full, I think, because we have reinsurance, we have a property and casualty business, we have classical life business, and we have unit links. Where for unit links I could see something, but it's still the question: is the money you are receiving, is it really not your money, or is it only a claim you are having? But it is a legal discussion. But these nuances are important for the industry. Because we have also a lot of P&C companies which would be then excluded as well because of the reason of someone else is doing something different. I think a much more cautious approach would be helpful by this.
Okay, understood. But we are not in this detailed discussion. Okay.
Yeah. Thank you.
No, thank you very much, Adam. Makoto.
Hello, thank you. Thank you very much. So I wanted to comment on the, Adam's perspective, especially he mentioned the IFRS 9, and not only Europe, but also Asia Pacific has a similar position that the recycling should be reintroduced to IFRS 9 equity. So we also felt the disappointment, and we don't think that disclosure would replace the So we will try to continue to communicate on that matter. So it may be included in the progress report to APEC Finance Minister this year as the remaining issue. So for the goodwill, we did not have a specific recommendation from APEC, but we are very interested because in the sustainability discussions in Asia Pacific, the two priorities has been selected. The one is the transition finance, and second is the innovation to contribute on SDGs and role of long-term institutional investors. So in that sense, maybe this good accounting for that matter might probably contribute. So the discussion is like in the past, it was a part of the infrastructure investment related considerations, but now a lot of sustainable investments by the insurance company, who are the largest asset owners in the respective economies, and those aspects can be related indirectly to the sustainability. And also, we are very interested in the ISSB's discussions, and we continue to collaborate and communicate both the inside of APEC and also with a counterparty like Europe. Thank you very much.
Okay, Marietta.
Thank you for unmuting me. I just want to come back concerning the chair's comment, what Adam mentioned, the fiduciary topic. Maybe it's usual only in Germany and in Austria, but concerning unit-linked insurance contracts, in general, the beneficiary has only benefit entitlement in cash and not in the funds themselves. So as Adam mentioned, that's the usual condition of our unit-linked contracts in Austria, similar to Germany. Thank you.
Thank you very much for that explanation. That helps. So, any other question? No? Nobody? Okay. So, thank you very much. As always, was very interesting discussion. Take some points. Sorry?
Doug has because
Oh, Doug?
Yes. Marcus, I just didn't want to end the call without thanking you again for this opportunity to have input into the group. I didn't want to do that after you closed. So before you close, just again, we appreciate it. We working with you, and we know it seems like we've done so much in so many years, and we still have so much more to go. So. And we know that the only way we can get someplace, you saw some of the very important issues that have been around a long time. Recycling, goodwill, these aren't brand new issues. And so we have to I think we really have to figure out how to get to a resolution of them. Otherwise, they're going to be on the agenda forever. We're very anxious to work with you all on this. So thanks again.
Thank you very much, Doug, for this kind statement. So I can give the compliments back because we enjoy working with you. And even when Adam was introducing himself with goodwill, I think it's quite an important topic, and we're always smiling because we are talking it over the years, and we all have the impression nothing is moving, or at least not in the direction maybe we wanted to have it, but this is highly political, I guess, also this topic. With that in mind, what we got out of the call is the equity, I call it recycling or no recycling issue. Also sustainability related questions with CSRD and also in general with the ISB. And also we take away the disclosure with regard to the fiduciary duty, which we will have a look on. So we had also other points, but those were the highlights, I would call them. And so thank you again very much for this interesting discussion. And also my message to you, we will keep up with the stakeholder sessions in the future. We find them very helpful and supportive, and we look forward for the next one. So thank you very much, and I would call it close now the stakeholder session. Thanks.